Question 1. In light of recent developments, Mr. Harrison owns a fabrication business that was recently contracted to install machinery in a commercial facility. The contract includes an indemnity clause that requires Mr. Harrison's company to assume liability for damages caused during installation, even if the fault lies partially with the facility's maintenance staff. During installation, fire breaks out due to faulty wiring in the building, and the property owners, both Mr. Harrison and the electrical contractor, Mr. Harrison files claim under his CGL policy. How is his claim most likely to be handled? A. The claim will be denied because the fire was not directly caused by Mr. Harrison's negligence. B. The CGL policy will cover the loss under personal injury liability. C. The policy may provide coverage under the contractual liability exception for insured contracts. D. The claim is fully excluded because indemnity clauses are never covered. Answer. Correct answer. C. Explanation. CGL policies generally exclude contractual liability, but an exception is made for insured contracts such as leases, sidetrack agreements, and hold harmless agreements where the insured assumes liability of another. This scenario falls under that exception, assuming Mr. Harrison's contract qualifies. Per the ISA 01 form and Arkansas Code SS3 601002, CGL policies coverage. Bodily injury and property damage liability may extend to this loss under the insured contract provision. Option A ignores that negligence doesn't need to be proven for indemnity obligations. B misclassifies the type of coverage. D is overly broad and inaccurate. Question 2. From multiple perspectives, understanding the distinction between covered causes of loss is critical in selecting commercial property policies. A restaurant in Little Rock sustains damage to refrigerated inventory due to a power outage that originated off premises. The owner has a building and personal property coverage form with a broad form cause of loss. Will this damage be covered? A. Yes, since spoilage from power failure is included in the broad form. B. No, because off-premises power failure is excluded unless endorsed. C. Yes, because refrigeration losses are always covered. D. No, spoilage is never covered under any property policy. Answer. Correct answer. B. Explanation. The broad form cause of loss does not include power failure that originates away from the insured's premises. To cover such losses, spoilage coverage endorsement, CP 440 or utility services, time element endorsement, CP 1545 is required. According to ISO guidelines and Arkansas commercial property endorsement rules, such endorsements must be requested and added. Option A wrongly assumes power failure is included. C and D are both overgeneralizations that do not reflect policy specificity. Question 3. Examining the consequences of this, Rodriguez operates a mobile pet grooming business. Occasionally, employees use personal vehicles to transport supplies. One employee, while using her own car to pick up grooming tools, rear-ends another vehicle. The injured party sues Rodriguez's business. Rodriguez only has standard business auto policy, BAP, without any endorsements. What is the most accurate outcome? A. The employee's personal auto policy will automatically defend the business. B. The BAP provides coverage because the employee was acting within the scope of business. C. The BAP does not apply without non-owned auto endorsement. D. There is no liability since the business didn't own the vehicle. Answer. Correct answer. C. Explanation. A standard BAP 01 does not extend coverage to non-owned vehicles used in business unless symbol 9 non-owned autos is listed and the non-owned auto liability endorsement is included. Without these, the business has no protection. Per Arkansas Insurance Code SS3 79201, failure to endorse means the insurer has no duty to defend. A. Misunderstands the scope of personal policies. B. Assumes broader business coverage than provided. D. Misrepresents vicarious liability. Question 4. From the perspective of consumer protection, which of the following scenarios would most likely result in disciplinary action by the Arkansas Department of Insurance against a licensed producer? A. Recommending a high premium policy with detailed disclosures. B. Accepting referral business from an unlicensed marketer. C. Placing a client's premium funds into separate trust account. D. Replacing competitors' policy with better terms after full disclosure. Answer. Correct answer. B. Explanation. per Arkansas Insurance Department Rule 36 and RSS 364512, accepting client referrals from unlicensed individuals acting as marketers or producers is considered violation, even if no commissions are paid. The act of influencing insurance decisions by unlicensed persons may lead to license suspension. AC and D are acceptable practices if full disclosure and proper record-keeping are followed. The core issue here is unauthorized solicitation, direct violation of producer conduct standards. Question 5. While examining a claim involving Mr. Wallace's manufacturing plant, an employee is injured while commuting to work. The employee files workers' compensation claim, asserting the injury should be covered since it occurred during phone call with supervisor. Mr. Wallace's policy is standard and unendorsed. What is the appropriate course of action by the insurer? A. Approve the claim due to employer involvement. B. Deny the claim based on the coming and going rule. C. Approve the claim as grey area exception. D. Deny the claim because only on premises injuries are covered. Answer. Correct answer. B. Explanation. The coming and going rule is a well-established workers' compensation doctrine excluding injuries occurring during commutes, even if work-related conversations occur. Unless the employee was performing specific errand or using company vehicle, the commute is not compensable. PNCI Basic Manual Rule 3. And Arkansas Code SS1 9102. Coverage applies during the course and scope of employment, which does not include commuting. A and C fail due to the lack of specific exception. D is overly restrictive. Question 6. The underlying principle of fidelity coverage is to protect businesses from internal threats. A nonprofit in Jonesboro discovers that its treasurer embezzled $90,000 over 2 years. The organization had a commercial crime policy with employee dishonesty coverage, but they failed to report suspicions during the first year of the theft. Will the insurer likely deny the claim? A. Yes, due to the prior knowledge exclusion. B. No, as long as the loss is within the policy limit. C. Yes, because dishonesty is never covered. D. No, because the crime is spread over 2 years. Answer. Correct answer. A. Explanation. Under employee dishonesty coverage, CR01, the insured must report known losses within 120 days of discovery. If management was aware of part of the theft and failed to act, the prior knowledge exclusion can bar recovery. The loss sustained form requires continuous coverage and prompt notice. Option B overlooks the notification condition. C is incorrect as dishonesty is precisely what is covered. D is irrelevant without timely reporting. Question 7. Through careful analysis of reinsurance structures, how does a facultative reinsurance agreement differ from a treaty reinsurance arrangement in commercial property underwriting? A. Facultative reinsurance applies only to life insurance, not property insurance. B. Facultative reinsurance involves case-by-case negotiation for individual risks. C. Treaty reinsurance is risk-specific and negotiated per loss event. D. Treaty reinsurance offers greater underwriting flexibility than facultative agreements. Answer. Correct answer. B. Explanation. Facultative reinsurance is negotiated individually for each specific risk, allowing the reinsurer to assess whether to accept or decline. In contrast, treaty reinsurance applies to entire classes or portfolios and is automatically binding per agreement terms. According to NAIC Reinsurance Model Act and ISO guidance, facultative coverage is ideal for unusual or high-risk properties. A is false. A facultative applies across all lines. C reverses definitions. D incorrectly states treaty is more flexible. Question 8. When considering a BOP for a growing business, which of the following factors would most likely disqualify an applicant from receiving BOP coverage? A. Operating more than one location. B. Having an annual revenue of $5 million. C. Being a general contractor with on-site work crews. D. Employing more than 20 staff members. Answer. Correct answer. C. Explanation. General contractors with on-site operations face significant liability and property exposures often exceeding the scope of standard BOP underwriting. Per ASA BP 03 and Arkansas-specific BOP underwriting guidelines, construction and contracting businesses are generally ineligible for BOPs due to their elevated risk profile. A, B, and D may still qualify if they meet other BOP conditions, such as square footage and industry class. Question 9. In a context of policy conditions, which of the following best illustrates a violation that may nullify a commercial property policy claim? A. Reporting the covered loss to the insurer within 90 days. B. Repairing damage before notifying the insurer. C. Not listing additional insured parties in declarations. D. Failing to include replacement cost valuation. Answer. Correct answer, B. Explanation. Most commercial property policies require the insured to preserve evidence of damage and allow inspection before repairs. C. Duties in the event of loss or damage clause in CP 010. Repairing property before notifying the insurer may invalidate the claim due to interference with the claims adjustment process. A may be late but still acceptable depending on policy terms. C affects coverage scope but not the claim. D affects valuation, not validity. Question 10. The emerging pattern of ransomware attacks has led many businesses to add cyber liability coverage. A tech consulting firm experiences a ransomware event that encrypts client data, and the hackers demand payment in cryptocurrency. The business pays the ransom and faces third-party lawsuits. Which of the following best describes the coverage required? A. Only third-party cyber liability coverage is needed. B. Only first-party coverage would apply. C. Both first-party and third-party coverages are necessary. D. Neither coverage applies because of criminal involvement. Answer. Correct answer, C. Explanation. First-party cyber coverage addresses direct losses, such as data restoration and ransom payments. Third-party cyber liability covers lawsuits from affected clients, regulatory fines, and breach notification costs, per ISO Cyber Suite SI01 and Arkansas Cybersecurity Framework. A complete policy includes both. A and B offer partial protection. D is incorrect, as coverage does not exclude criminal origin if properly endorsed. Question 11. The central argument for many insurer litigation cases is the alleged failure to act in good faith. Is Lively files a property damage claim for her small cafe in Conway, Arkansas. She provides full documentation and follows all policy requirements. Her insurer, however, takes over 90 days to respond despite multiple follow-ups. As a result, Is Lively suffers business interruption losses and reputational damage. What legal principle most directly applies here? A. Comparative fault. B. Doctrine of proximate cause. C. Bad faith handling. D. Subrogation rights. Answer. Correct answer, C. Explanation. Under Arkansas Code SS3 79208, insurers have duty of good faith and fair dealing, which includes timely investigation and communication. Failing to respond within reasonable time, particularly after receiving adequate information, can be classified as bad faith, exposing the insurer to damages beyond the policy limits. A and B are tort law principles, irrelevant here. D applies to recovery after claim is paid, not to insurer misconduct. Question 12. Given the circumstances, a mid-sized Arkansas nonprofit's board of directors is sued by donors alleging misappropriation of funds and breach of fiduciary duty. The nonprofit has a DO policy in place. Which of the following is most likely excluded under the standard policy? A. Allegations of financial mismanagement. B. Bodily injury claims arising from a slip and fall an event. C. Breach of fiduciary responsibility in budgeting. D. Claims of negligence in oversight of hired staff. Answer. Correct answer, B. Explanation. DO policies cover claims made against directors and officers for wrongful acts, typically financial or managerial in nature. Bodily injury claims, however, fall under general liability CGL coverage, not DO. According to the ISO Management Protection Policy and Arkansas-specific endorsements, standard exclusions include bodily injury, property damage, and intentional illegal acts. Options A, C, and D are typical DO exposures. Question 13. Among the various inland marine coverage options is Colled, who owns a landscaping business, insures his heavy machinery using a contractor's equipment floater. One weekend, vandals break into the fenced equipment yard and damage 2 bulldozers. The policy has an exclusion for equipment left unsecured at non-job sites. Will the claim be honored? A. Yes, because it was stored on owned premises. B. No, because the equipment was not in transit or on job site. C. Yes, due to the vandalism peril being covered. D. No, due to policy exclusion for unattended equipment off-site. Answer. Correct answer. A. Explanation. Contractors' equipment policies under inland marine are designed for equipment that is mobile and used across locations. If the equipment is secured on own, scheduled premises, the policy will generally respond to cover perils like vandalism per ISO centimeter 01 and Arkansas underwriting standards. Exclusions for unattended equipment usually apply to unscheduled or transient locations. Misstates the purpose of the coverage. C is partially true but lacks full context. D misapplies the exclusion. Question 14. The prevailing attitude toward professional liability policies is misunderstanding the importance of claims-made causes. Dr. Nguyen, a management consultant, had a professional liability policy from 2021-2023 with Insurer A. In 2024, former client sues for negligent advice given in 2022. Dr. Nguyen now has new policy with Insurer B. Who is liable? A. Insurer A, because the incident occurred during its policy term. B. Insurer B, because the claim was made during that policy term. C. Neither, because the claim falls outside the discovery period. D. Insurer A, if retroactive date and tail coverage were in place. Answer. Correct answer. D. Explanation. Under claims-made policies, coverage is triggered when the claim is made, not when the event occurred. If tail coverage extended reporting period was purchased, or if the policy has a retroactive date that precedes the incident, then insurer may be liable. Per ISO PL 01 and Arkansas Insurance Regulation Rule 45, these conditions are essential for maintaining continuity. A. Wrongly applies occurrence rules. B. And C. Fail to consider tail retro coverage. Question 15. To better understand how policies are modified, which of the following best describes the function of an endorsement in a commercial property policy? A. It voids the entire contract upon breach. B. It replaces the declarations page with new limits. C. It adds, deletes, or modifies policy terms. D. It outlines insurer financial obligations in bankruptcy. Answer. Correct answer. C. Explanation. Endorsements are legally binding documents that amend the original policy either by adding coverage, deleting terms, or changing limits or definitions. They become part of the insurance contract. This is outlined in ISO Policy Form CP110 and regulated under Arkansas Code SS3 79103. A. Describes material breach. B. Incorrectly assigns the role of the declarations page. D. Refers to financial solvency procedures, not policy changes. Question 16. The foundation of auto liability coverage under the Business Auto Coverage Form is in understanding symbol usage. A company in Fayetteville uses symbol 7 in its back declarations. One of its newly purchased vehicles is involved in a liability incident before being reported to the insurer. Which statement is true? A. Coverage applies automatically for 30 days. B. No coverage applies unless the vehicle is scheduled. C. Symbol 7 covers any vehicle used in the business. D. The vehicle is covered because it is owned and financed. Answer. Correct answer. B. Explanation. Symbol 7 restricts coverage to specifically described autos listed on the declarations. New acquisitions must be reported and endorsed. Unlike Symbol 1, any auto, or Symbol 2, owned autos, Symbol 7 does not provide automatic coverage unless explicitly stated. Per ISO 01 and Arkansas Commercial Auto Policy Guidelines, failure to notify may leave the vehicle uninsured. A applies to some symbols, but not Symbol 7. C is Symbol 1's description. D is irrelevant without scheduling. Question 17. By evaluating loss settlement outcomes, a small business suffers a $200,000 loss. Their property is insured for $400,000 with an 80% coinsurance clause, but the replacement cost of the building is $700,000. Assuming no deductible, what amount will the insurer pay? A. $160,000. B. $200,000. C. $142,857. D. $175,000. Answer. Correct answer. A. Explanation. The coinsurance formula is did should X loss equals 400,500 60,000 x equals 100, 60,000 text did should x loss equals 400,000 500, 60,000 x 200,000 equals 100, 60,000 did should x loss equals 400,000 500, 60,000 x equals 100, 60,000 should it is 80% of the replacement cost. 0.8x 700,000 equals 560,000. This formula is specified in AS OCP 010 and Arkansas Property Loss Settlement Rules. Option B assumes full coverage. C miscalculates the ratio. D applies the wrong percentage. Coinsurance encourages proper valuation and penalizes underinsurance. Question 18. Upon closer examination, an umbrella policy offers drop-down coverage when A. the underlying policy limits are exceeded, B. a claim is excluded under the umbrella but covered by the primary policy, C. the umbrella covers a loss not covered by the underlying policy, D. the umbrella policy includes aggregate limits only. Answer. Correct answer, C. Explanation. Drop-down coverage occurs when an umbrella policy covers a loss excluded from the underlying coverage, acting as primary coverage subject to self-insured retention, sir. This feature is detailed in ISO Q01 and supported by Arkansas umbrella policy guidelines. A is excess coverage, not drop-down. B is contradictory. D misstates the coverage structure. Question 19. Throughout the course of a farm insurance review, Mr. Atkins suffers a fire that destroys several barns and mobile farming equipment. His policy includes scheduled coverage for barns and unscheduled blanket coverage for farm personal property. What will the insurer do? A. Pay the scheduled value for barns and actual cash value for equipment. B. Deny the equipment claim for lack of scheduling. C. Pay replacement cost for all losses. D. Apply coinsurance only to the barns. Answer. Correct answer, A. Explanation. Scheduled property is typically insured at stated or replacement value, while unscheduled items are covered up to a blanket limit, often on an actual cash value (SCV) basis unless otherwise endorsed. Per ISO Farm Program Forms FP012 and FP014, barns, structures, and equipment movable property are handled under distinct coverage parts. Coinsurance may apply to both stated in declarations. B is incorrect. Unscheduled coverage still applies. C requires an endorsement. D is too narrow. Question 20. The correlation between policyholder rights and cancellation notices is a key consumer protection area. A commercial insured in Arizona receives a notice of cancellation 12 days before the proposed termination date. The reason cited is non-payment of premium. Is the notice compliant? A. Yes, because it's over 10 days in advance. B. No, because all cancellations require 30 days notice. C. Yes, because non-payment only requires 5 days. D. No, because it was not sent by certified mail. Answer. Correct answer, A. Explanation. Under Oz SS 01674 for non-payment of premium, insurers must provide at least 10 days advance notice. The law does not require certified mail, though documentation of notice is essential. B. Confuses with non-renewal or other cancellation reasons. C. Misstates the minimum period. D. Adds an unnecessary requirement not found in statute. Question 21. In a modern context of advertising liability, is Bennett runs a printing business and receives a claim alleging that an advertisement she produced for a client contained libelous statements about a competitor. The client sues both Is Bennett and the business. What coverage will the commercial general liability policy most likely provide? A. Coverage for personal and advertising injury liability. B. No coverage because advertising injury is excluded under CGL. C. Coverage only if the suit alleges bodily injury. D. Coverage is provided only under professional liability insurance. Answer. Correct answer, A. Explanation. The commercial general liability (CGL) policy includes coverage for personal and advertising injury liability, which covers claims such as libel, slander, and false advertising under coverage B. This is detailed in the ISO CG01 form. Option B is incorrect because advertising injury is specifically covered under the standard CGL form. C confuses bodily injury with advertising injury. D is incorrect since professional liability generally covers errors in professional services, not advertising injury. Question 22. Taking into account a commercial bakery in Little Rock that suffered a fire causing significant interruption, the business has business income and extra expense coverage. After the fire, bakery ovens were unusable for 3 weeks. How does business income coverage assist the insured? A. It reimburses actual lost net income and continuing expenses during restoration. B. It covers only the replacement cost of damaged ovens. C. It pays for fire suppression system repairs only. D. It covers only extra expenses exceeding normal operating costs. Answer. Correct answer. A. Explanation. Business income coverage reimburses the net income lost due to interruption and pays for continuing normal operating expenses during the restoration period. Extra expense coverage covers additional costs to minimize interruption. The ASA CP 030 form details this. Option B refers to property coverage, C is part of property or equipment coverage, and D refers only to extra expenses, not lost income. Question 23. When analyzing fraud risks, a company's bookkeeper forged signature on checks to divert funds to personal account. The company has commercial crime coverage with forgery or alteration protection. Which of the following best applies? A. The insurer will cover the loss only if the forgery was committed by a third party. B. The insurer covers losses caused by forgery regardless of employee status. C. Forgery coverage excludes employee dishonesty, so no payment will be made. D. The company must prove it did not authorize the forged signatures. Answer. Correct answer. B. Explanation. Forgery or alteration coverage protects against forged or altered checks, drafts, or similar instruments, regardless of who committed the forgery. This includes employee forgery. However, employee dishonesty coverage is separate. This is specified in ISO Crime Form CR07. A is false as employee forgery is covered. C misunderstands the distinct coverages. D is irrelevant because forgery is unauthorized by definition. Question 24. Considering the evidence, a local auto repair shop holds customer vehicles overnight. One vehicle is damaged in a fire on the premises. The shop carries garagekeeper's insurance. What type of coverage applies to the damage? A. Liability coverage protects the shop from claims for damage to vehicles. B. Garagekeeper's insurance provides physical damage coverage for customers' vehicles. C. Damage is excluded because the fire did not occur during active servicing. D. The owner's auto policy must cover the damage. Answer. Correct answer. B. Explanation. Garagekeeper's insurance covers damage to customers' vehicles in the care, custody, or control of the garage operator, including fire damage. This is distinct from liability coverage, which protects against claims for bodily injury or property damage to third parties. The ISO Garage Coverage Form 2022 outlines this. A. Confuses liability with physical damage coverage. C. Is incorrect if the coverage applies regardless of servicing status. D. Applies only if garagekeeper's coverage is absent. Question 25. In an effort to complete a commercial construction contract, Easter O'Neill obtains performance bond. The contractor defaults midway through the project. Which statement best describes the surety's obligations? A. The surety must pay the owner the bond amount immediately. B. The surety is obligated to either complete the contract or pay damages up to the bond amount. C. The surety has no obligation if the contractor is bankrupt. D. The surety assumes ownership of the project property. Answer. Correct answer. B. Explanation. A performance bond guarantees that the contractor will complete the project per contract terms. Upon default, the surety must either complete the contract or compensate the obligee for losses up to the bond limit. This is governed by the Model Performance Bond Form and Arkansas Surety Bond Laws, Arkansas Code S7 241001 et sec. A is inaccurate as payment is not immediate. C is false. A bankruptcy triggers surety action. D is incorrect. The ownership does not transfer. Question 26. From a practical standpoint, is Alvarez's company faces lawsuit alleging wrongful termination and discrimination. A commercial liability policy excludes these claims. Which coverage best addresses these exposures? A. Commercial general liability. B. Employment practices liability insurance. C. Directors and officers liability. D. Workers' compensation. Answer. Correct answer. B. Explanation. EPI specifically covers employment-related claims such as wrongful termination, discrimination, harassment, and retaliation. These are generally excluded from standard CGL policies. The ISO EPIL Form EPIL 01 and Arkansas regulatory guidelines recommend separate EPI coverage for these exposures. A excludes employment claims. C covers management liability, but generally not employee claims. D covers workplace injuries only. Question 27. Given the circumstances, a developer is constructing a commercial office building and wants coverage that includes materials stored off-site and in transit. Which policy best meets these needs? A. Commercial property coverage form. B. Builder's risk coverage form. C. Inland marine equipment floater. D. Business owner's policy. Answer. Correct answer. B. Explanation. Builder's risk insurance is designed to cover buildings under construction, including materials and supplies, both on-site, off-site, and in transit, subject to policy limits. The ISO Builder's Risk Form CP01 outlines these coverages. They typically excludes materials not on premises. C covers equipment but not buildings under construction. D is for operating businesses, not construction. Question 20. In terms of supplementary payments under a commercial general liability policy, which expenses are typically covered without reducing the policy's limit of liability: A. Defense costs, interest on judgments, and first aid expenses. B. Damages awarded to third parties. C. Policy premiums and underwriting fees. D. Lost business income due to claim. Answer. Correct answer. A. Explanation. Supplementary payments under coverage, and B. Usually cover defense costs, post-judgment interest, bail bonds, and reasonable expenses such as first aid without eroding the limit of liability as stated in the CG01 form and Arkansas insurance regulations. B. Damages reduce policy limits. C. Is not covered. D. Relates to business income coverage. Question 29. While examining a loss involving a warehouse that has been vacant for over 90 days, the insurer finds that fire damage was caused by faulty wiring. The policy's vacancy provision excludes coverage after 60 days of vacancy. How will this affect the claim? A. The claim is fully payable because fire is covered peril. B. Coverage is denied due to vacancy clause exclusion. C. Partial coverage applies after deductible. D. The claim is covered only if the insured can prove due diligence in maintenance. Answer. Correct answer. B. Explanation. Most commercial property policies include a vacancy clause limiting coverage when a building is vacant for a specified period, often 60 days. This clause excludes perils such as fire, vandalism, or sprinkler leakage if vacancy exceeds the limit. According to ISO CP 010 and Arkansas rules, coverage is denied if the condition is not met. A. Ignores the vacancy provision. C. And D. Are unsupported by standard policy terms. Question 30. Across different scenarios, a business suffers a data breach exposing customer personal information. Which coverage under a cyber liability policy typically reimburses costs associated with notifying affected individuals and regulatory agencies? A. First-party privacy breach response coverage. B. Third-party bodily injury coverage. C. General liability coverage. D. Employment practices liability. Answer. Correct answer. A. Explanation. Cyber liability policies provide first-party privacy breach response coverage to pay for notification costs, credit monitoring, public relations, and regulatory fines following a data breach. This is critical under laws like Gramm-Leach, Bliley, GLBA, and Arkansas Personal Information Protection Act. B. Bodily injury coverage is unrelated. C and D do not cover privacy breach